Welcome to another special edition of the 3 in 10 podcast. These discussions with investment or industry leaders are set apart from our regular Friday podcasts. They are both longer and more in depth. We hope you will enjoy, learn, and profit from this special edition of the 3 in 10 podcast. Well, welcome everybody to a special 3 in 10 podcast. I have with me today Michael Parekh, a former Goldman Sachs partner and a former Goldman Sachs technology strategist who was the head of internet research for Goldman Sachs back in the 1990s. And I believe Michael worked at Goldman for decades and was really lucky to start in 1981. I can't imagine more perfect timing than that. But Michael worked with some of the greats in the PC era, Rick Sherlund, who helped bring Microsoft public. I think that was 1986. Dan
Correct.
Benton, who was a leading light covering the PC industry during its rapid growth phase.
And we took that public in 88.
Yeah. And Lee Cooperman, who was the iconic head of research at Goldman, who went on to start Omega Partners, that was one of the great early hedge funds. Abby Joseph Cohen, Steve Einhorn were colleagues of Michael's, and even New York Fed Governor Bill Dudley. So this man has worked with the greats. He stood the test of time. He's been there. He was at Goldman for decades. He's seen the dawn of the PC, the rise of the internet in the mid-90s, the era of the smartphone beginning around 2005, of course, the rise of the Mag 7, and now artificial intelligence, which is on every investor's mind. Where do we stand in this unbelievable capital spending cycle? Are the returns really going to be there? So today we have someone with 44 years of experience at the nexus of technology and financial markets. And so, Michael, I just want to welcome you to the 3 in 10 podcast. For the audience, we're going to be conducting a fireside chat today. The date is October 28th, 2025, and we're recording at approximately 9:30 a.m. Central Daylight Time. So with that big introduction, I want to just turn it over to Michael to just give some introductory comments and thoughts, and then we'll get into the meat of the fireside chat. We're going to probably go for about 40 minutes. So Michael, over to you.
Thank you, first of all, Scott, for that wonderful, kind introduction. It's always weird to kind of see your life in the context of decades when you're, so excited about just everything that's going on in the current day. And I'll say, and both of us kind of grew up in the financial world and in the investment world around, the same time frames. And so we share a lot of not just friends and acquaintances, but a lot of these events together and seeing them from, different vantage points. But from my perspective, and I've said this publicly, I write a daily AI missive on a Substack at michaelparekh.substack.com. And one thing I've said in the introduction there, and I repeat it all the time, is that everything I have done in technology across 3 or 4 major technology waves, and where we are with AI, as I deeply look at AI from a technology point of view, bottom up every day, everything that I've done in technology and the financial markets is but a dress rehearsal for what's about to happen over the next 10 or 15 years. And it's important to us, not only from the point of view of us as investors, but also in terms of our friends, our families, about how we are going to be impacted by these technologies yet again in a massive way, just like we have been with the advent of the phone over the last 15 years since Steve Jobs brought it up, the iPhone on the stage in 2007, and obviously the internet, which I was involved with since 93. And as you mentioned, all the way going back to the PC, which, when I started at Goldman in 1982, the personal computer was literally Time Magazine's Person of the Year for the very first time, recognizing its potential epochal implications for technology, which it was, because it was the big transition point from the mainframe computer, IBM, and how it dominated the world to where we are today. And I bring up IBM because what we are going through right now with AI, and we're going to talk about it in terms of the hundreds of billions of dollars that are being invested, we are in what I call the mainframe era of AI, which is that to do AI, you need big, large, centralized computers. In the IBM era, we needed huge computers. The IBM 360 was a venerable model back then. But today, we need huge numbers of these computing devices all centralized into these things called AI data centers, which then are connected by huge amounts of fiber and power that literally cost tens of billions of dollars and up for 1 gigawatt
Michael,
data center.
back in the IBM era, we used to call it big iron.
Big iron.
Remember that phrase?
Correct.
IBM
Correct.
had the big iron. Those big mainframes.
You're totally
Now
right.
look like dinosaurs.
They're dinosaurs, yet they're not dinosaurs in the sense that we're taking the same frameworks, the boxes, and now the computing power, the transistors, which is the core component of all computing over the last 70, 80 years. The transistors have just exploded, right? In those mainframes that the companies spend tens and hundreds of millions of dollars, there were maybe a few 100,000 transistors. Today, our humble iPhones have 15 to 20 billion transistors, and the base chip from NVIDIA, which provides 90% of the AI GPU chips, their Blackwell chip has over 150 billion transistors, just to give you a sense. So the core computation mechanism is still the same. It's just how we use those transistors is very different from the age of traditional software, which was what I call deterministic software, to AI software, which is probabilistic software. And I can go and explain that in a little bit if you like. But that is the big switch. That is the big transition that we're just started in a dramatic form since the age of ChatGPT, which is what most people think of as AI, which is OpenAI's ChatGPT, which was introduced to the world on only 1,063 days ago today. So that was on November 30, 2022. Yet AI and machine learning has been around for decades, and we have all been using it. Every time we get into our cars and do GPS, that's AI. Every time we order Uber Eats or order an Uber, that's AI. But this is a new form of AI, and that's the beginning of the beginning right now.
So, Michael, of course, our listeners are interested in investing, and one of the things I've been astounded by with AI is that look who some of the leaders are. Microsoft. Well, you took that public back in 1986. We just talked about IBM. I went through the IBM last quarter. It was an amazing quarter. IBM is thriving in this. Companies like Dell doing incredibly well. Dell, you brought that public in 1988. And let's not forget Larry Ellison's Oracle, another one that has been around.
48 years old, Oracle, 48 years old, led by a founder, 81 years old, who is literally going to provide the majority of the AI compute for OpenAI, which is the new baby that is going to pay them, hundreds of billions of dollars as they make it. So that's but the core part of Larry is he can absolutely change his view on a whim, and he is extraordinary. Even at 81, he's got the flexibility of a 20-year-old and the ferocity to compete, and that's the cool thing to see.
Yeah, some of these 80-year-olds are pretty fearsome guys these days. So I have to ask you, how are you investing your dollars in this AI boom? Where do you think we are in the cycle? Is it too late to invest in public markets? Is it too late to invest in private markets? Or is it still, how are you thinking about the investing process in AI today after we've had a 3-year boom?
I want to underline if I want one thing to kind of for people to take away, we are in the earliest days of what I call the AI tech wave. Since we brought up 82 as a marker when the IBM PC became recognized in a mainstream way on Time Magazine's cover. The PC industry had actually started in the late 70s. Bill Gates started and Paul Allen started Microsoft in the late 1970s. Same thing, Steve Jobs and Wozniak started Apple, 3-4 years ago. We are at that stage with AI. In other words, we're at the 81, 82 period, barely, if I have to kind of gauge these things, which from my perspective, whether you're a public investor or a private investor, you haven't missed anything. In fact, as head of Goldman's internet research, which I started in 1993, we participated in bringing a lot of the greats public, the Yahoos, the eBays, the Amazon, obviously Google, which got formed in 98. When the first internet crash or the dot-com crash happened in 2002, I vividly remember, and I can put it up online, it's on my Substack. I did a piece on this on Amazon. If you just search for Amazon.bomb, you'll see it. Barron's had a cover story with a big bomb and a caricature of Bezos called Amazon.bomb. And this was in 2002. The stock had gone down 98%. And, and I've been an investor since you asked me my personal, I left Goldman after 20 years in the early 2000s, and I became an investor. And I've been a private and a public investor in all these things that we could deem internet and now AI for a very long time. So I've just been a very long-term investor. I tend to invest in these things, both from index and then specific companies, but I'm a long-term investor. So my biggest things are things that you and I are very familiar with. So, we talk about the Mag 7s, the Googles, the Amazons. My point with the Amazon.bomb story is if you'd bought Amazon at that point as a public company back then and just held it from there to now, you would have made better returns than any of the venture folks in that company. And it's the same kind of thing. Even Google today, which, yes, if you ask the chief equity strategist at Goldman or Morgan today, they'll say, yeah, the general valuations of the broad markets, S&P 500, et cetera, stretched. They're driven 40-50% by the Mag 7s, the 10 companies in the technology realm, and they're all at the upper end of their PE kind of ranges historically. But the core thing to remember, because we talk about these layers of technology cycles, is that the founders and the chief executives of all these companies have learned and internalized the lessons of the past curves. So what they are not doing this time is being incumbents. They have aggressively invested just like they were startups, putting huge amount of chips on the table, which, most, in the PC era, no other company that was going to see the PCs did that, or computing. In fact, the head of digital equipment, which you remember, he's famous for a quote. You can Google it. He said, "I don't see any reason why there are going to be many more than half a dozen personal computers in any house, in any place out there." They didn't see it. Today's incumbents totally see it. They don't want to miss it, which is why we have this extraordinary period where the top 6 or 7 Mag 7s that we call them are investing north of $300 billion a year on AI capex, way ahead of the revenues that they're going to get as billions of people actually adopt AI and as the applications are built, which will take several years to do. We'll talk about
Michael,
that.
I have to ask you, given that enormous amount of capex, how are they going to earn a 15% ROIC on those kinds of numbers? What would actually have to happen for them to generate good returns for their shareholders?
Great question. That is exactly what they think they're going to do, but they're thinking, and I think they're right. Their returns are going to be much higher than that, because technology, the key challenge in technology in every wave is you have to get to scale first. Okay, let's use that. That word sometimes gets overused. But the scale just means you want to be one of the top 2 or 3 companies that are in the leadership position in terms of whatever the addressable market is. You're in the top 1, 2, 3, because then the rewards of the flywheel, as people come on, as your costs go down, you can add more services. This flywheel that Amazon made famous on a napkin. I wrote about that on my Substack, and you can, just do Amazon flywheel and you'll find the post with the pictures. But Jeff Bezos learned that word from the Costco founder. So it's not a technology-driven thing. My point is, as these flywheels happen at scale, as people start to use these services, et cetera, then the margins and the returns come in spades. And technology is a business where the underlying costs, because of Moore's law and so on, goes down continuously for pretty much for a long time, if not, I won't say forever, but for a very long time. And the capability of the technologies go up exponentially every 2 or 3 years. And we're seeing that in spades with AI. And that's why they're investing. The reason they're investing right now, and this is a differentiating point relative to all the other tech cycles. This time, AI is a business where to do this kind of math computation of probabilities, you need huge amounts of new types of computers, which are powered mostly by NVIDIA's GPUs. It's parallel processing, they do a huge amount of what's called matrix math, which is a fancy word for a lot of probabilities on all the data on the internet and increasingly in our lives, in our offices, businesses. And it does these probabilistic computations, put it all together, and then tries to answer your questions. And to do that at scale, you just need huge amounts of computer processing, which is what the data centers are. It's no different than when Edison invented the light bulb. Everyone got excited when they saw that the light bulb could replace the candle in your office. But at the same time, you realize to do the electric bulb, you're going to need to wire up the building and the office and the city and so on, and you need General Electric. And in fact, that's what it led to. We are at that stage on the AI side, and that's what these companies are doing. So you may think it's mad.
It's in your opinion, it's not a financial bubble.
No,
it's probably a long-term wave where we're going to have some extreme pullbacks in the wave
totally.
As things get overcooked on the upside.
Totally. I'm an analyst on this, much more focused on the technology first. And then I obviously keep an eye on financial returns, margins, growth, et cetera. I have various charts in the stuff I do where I talk about the revenue, margins, all of that stuff on the left-hand side. And they're very important, but they happen over years, not over months and quarters, especially in the early days. And that's the thing to remember. On all these CEOs, that's what they're shooting for. And right now, investors are giving them the rope to hang themselves, as it were, in terms of the hundreds of billions of dollars. And these are extraordinary sums. Let's not make any misconceptions on that. I mean, it took, when the U.S. was in a space race with the Soviets from 1969 to 1974, in terms of putting a man on the moon, we spent as a country, in today's dollars, probably north of $300 billion to put 14 men on the moon. No, 12 men, 12 men on the moon. So huge, billions of dollars per person. And that's what these companies are spending in a year right now. And so the good news is most of the companies like Microsoft, Google, Meta, their balance sheets are so big, their cash flow is so big, they can mostly, until this year, fund it from their free cash flow. We are now in a stage, over the next 3 years, they are increasingly going to have to go to debt vehicles as well. So they are raising debt. Meta just...
An interesting opportunity for private credit, I will add there.
Huge opportunity. That's why the Blackstones and so on are totally in.
Reading you
for
right,
tens of billions of dollars. Yeah.
If I'm hearing what you're saying correctly, we shouldn't anticipate a 1999, 2000 kind of bust where we go fallow for 5 or 7 years. You see more of a long wave up with violent 20, 30 maybe even 40% corrections along the way, but not a bust for years like we did with the internet.
I would be surprised at a bust that lasts years, like the internet, because that was actually the most, the best part of my investment life in the 2000s, in the internet winter, because everything was so inexpensive. I'd be surprised if we see that, because the underlying technologies for AI that we're talking are just getting started. They're making 10x, 20x type of improvements every 6 months, which means that even if we have a 20%, 30% correction in, let's say, the Mag 7s over the, let's say, the next 12, 18 months, the markets by definition will not allow that crash to stay, because the companies will be able to show you that people are adopting the newer technologies faster, and you'll be able to project the potential revenues, market share, margins, and returns on investment on that capital. So the capital will keep flooding back in, right?
There's such an important distinction, because I know as I've been investing, of course, I'm fighting the last war. I'm thinking about the internet, made all this money in the late 90s, gave a lot of it back, and it went busted for years. And I think that's the fear, is that when you have bubbles, you usually make V tops, and it takes a decade to make new highs. We know Japan in the late 80s. We know gold in 1980. We know there's so many, the internet bust. There's so many examples of a boom that goes bust, and it's busted for years. But I have a lot of sympathy for your view that this one's going to be different.
The one thing I will just add to this picture is, because since we talked a lot about the massive investments and the mainframe aspect of the AI boom, I just want to another analogy that I've written a lot about on my Substack in detail for the analyst types out there, is that the mainframe to the mobile curve took about 40 years in the technology world. In the AI version of it today, we're going to go from the mainframe era of AI to, let's call, the mobile era in probably 5 to 8 years. So the compression is massive. So what does that mean for everything we're talking about? A big amount of the compute that's all these companies are building these data centers for is for what's called inference computing, which is what that, it's a buzzword. That means anytime any one of our listeners is asking ChatGPT something or Google Gemini something by voice or text, the system is basically doing huge amounts of math computation, probabilistic computation on everything it can find on the internet and the data, and doing these computations to answer that question. That computation today can only be done mostly on the mainframe type data centers. But increasingly, these phones, the latest iPhone 17 and the 18 and the 19 and the equivalent from Android, they are making leapfrog improvement in the billions of compute GPUs that are in these devices. So a lot of the compute pressure is shifting from the mainframe to local. Your PCs, your laptops are now AI PCs. If you look at, your Microsoft is selling these things called AI PCs. Apple is doing the same thing. So in the next 4 or 5 years, there's going to be so much compute available locally that it will take a lot of the load off the servers. And so that does also cause potential volatility in the demand for all the server capacity. So that's another potential thing that people worry about. So, I would say for the people who are worried about an AI bust, the bigger thing you want to not worry about, but be mindful about, is not an AI bust per se, but the supply-demand shift that could happen if the compute environment on this goes up so fast that it literally creates an air pocket or two for the compute loads that are being built up on the mainframe. Now, I don't anticipate that anytime soon over the next 2 to 3 years, because even this buildup of AI on local devices will take several years, as I said, but it's something to be mindful about. And I bring it up only because for the long-term investors in your audience, the people who are saying, I want to just, buy Google or buy Meta or Apple and just not think about it for the next 4 or 5 years, everything we've talked about benefits most of those companies on both sides of the mainframe and the local AI side of the equation, because each of those companies already today serves billions of users. And they're just adding AI into the mix at various capabilities. And we're at the beginning of the kinds of things people will do with that AI. And ChatGPT or chatbots is just the beginning of what people can do with these computers, this new type of computing. And that's why I'm so fundamentally excited about it, but with open eyes, just clear eyes in terms of the volatility that will be with us.
Yeah. So those that have kind of missed it so far are going to get their
You've
opportunity.
not missed it.
They shouldn't be
You've not
dismayed
missed
that it's
it.
over. This concludes part one of my interview with Michael Parekh, independent technology strategist and AI expert. We will be back with part two of our discussion later this month. Thank you for listening.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.